The American dream, once a symbol of endless possibilities, is now facing a harsh reality. The once roaring economy is sputtering. The United States is on a dangerous path towards a recession. Despite attempts to steer clear, economic indicators are pointing in a troubling direction. In this video, we'll dive deep into the factors slowing down the US economy. From the impact of rising interest rates to the weakening consumer spending power, we'll explore the challenges ahead. We'll also discuss the potential consequences of a recession and what it could mean for you. And most importantly, we'll provide some tips on how to protect yourself from the potential economic storm. The US economy experienced a significant slowdown in the first quarter of 2024, with GDP growth coming in at a mere 1.4% annualized rate. This represents a notable decline from the previous quarter's growth and falls short of expectations. While this single quarter of slow growth doesn't technically constitute a recession, which is typically defined as 2 consecutive quarters of negative GDP growth, it signals a troubling trend and raises concerns about the economy's overall health. Consumer spending, the primary engine driving the US economy, has shown signs of fatigue. While it continues to grow, the pace of increase has notably slowed down. Several factors contribute to this trend. Inflation. Rising prices are eroding consumers' purchasing power, leaving less disposable income for discretionary spending. Interest rates. Higher interest rates increase the cost of borrowing, which can dampen consumer confidence and reduce spending on big-ticket items. Shifting priorities. Consumers may be reallocating their spending towards essential goods and services, reducing spending on discretionary items. The labor market, while still relatively strong, has shown signs of cooling. Job growth has decelerated compared to previous periods, and although unemployment remains low, there are indications of a tightening labor market. This could lead to increased wage pressures, which can further fuel inflation. Moreover, a softening job market can erode consumer confidence, leading to reduced spending. The US economy grappled with a surge in inflation in 2022, reaching levels not seen in decades. This was primarily driven by factors such as supply chain disruptions, pent-up consumer demand following the pandemic, and increased energy costs. To combat this rising inflation, the Federal Reserve initiated a series of aggressive interest rate hikes. The Federal Reserve's response to soaring inflation was to rapidly increase interest rates. This monetary policy tightening aims to cool down the economy by making borrowing more expensive, thereby reducing consumer spending and business investment. While effective in curbing inflation, these rate hikes have had broader economic consequences. The Federal Reserve's aggressive monetary policy has raised concerns about tipping the economy into a recession. By rapidly increasing borrowing costs, there's a risk of stifling economic growth. As businesses and consumers face higher interest rates, they may reduce spending and investment, leading to a slowdown in economic activity. This delicate balancing act between controlling inflation and avoiding a recession is a significant challenge for policymakers. Consumer spending, once a stalwart of the economy, is facing increasing headwinds. Rising inflation, coupled with higher interest rates, is squeezing consumers' wallets. This is leading to a shift in spending priorities, with a focus on essentials and a cutback on discretionary items. Additionally, there's growing uncertainty about the future economic outlook, which could further dampen consumer confidence and spending. The business landscape is also grappling with challenges. High interest rates are making it more expensive for businesses to borrow money for expansion or investment in new projects. This is leading to a slowdown in business investment, which is a crucial component of economic growth. As a result, companies are becoming more cautious, opting to prioritize debt repayment and cost-cutting measures over growth initiatives. Economic experts are expressing growing concern about the potential for a recession. Many believe that the combination of high inflation, rising interest rates, and softening consumer spending creates a perfect storm for economic downturn. While some experts remain optimistic about the economy's resilience, the prevailing sentiment is cautious. The consensus seems to be that the next few quarters will be critical in determining the overall economic trajectory. Several factors are contributing to the heightened risk of a recession. Persistent inflation, coupled with aggressive interest rate hikes, creates a challenging environment for both businesses and consumers. A potential shock to the global economy, such as a geopolitical crisis or a significant financial event, could also trigger a recession. Additionally, a prolonged period of weak consumer confidence and declining business investment can exacerbate the downturn. A recession can have severe consequences for individuals. Job losses are common during economic downturns, leading to financial hardship for many. Reduced income can force people to cut back on spending, leading to a downward spiral in consumer spending. Moreover, the value of assets like homes and stocks often declines during recessions, impacting individuals' wealth. A recession typically leads to a decline in stock market values. Investor confidence erodes as economic uncertainty grows, prompting a sell-off in stocks. Companies often experience decreased profits or losses during recessions, which negatively impacts their stock prices. Additionally, the overall market volatility increases, making it challenging for investors to navigate the turbulent waters. One of the most effective strategies for managing investment risk during a recession is diversification. By spreading your investments across different asset classes, industries, and geographic regions, you reduce your exposure to any single investment. This means that if one part of your portfolio suffers losses, it can be offset by gains in another. A well-diversified portfolio can help to cushion the impact of a recession. Effective risk management is crucial during economic downturns. Consider these strategies. Rebalancing. Regularly review your portfolio to ensure it aligns with your risk tolerance and investment goals. Dollar cost averaging. Invest a fixed amount of money at regular intervals regardless of market conditions. Emergency fund. Build a substantial emergency fund to cover living expenses for several months in case of job loss or reduced income. Avoid panic selling. Emotional decisions often lead to poor investment outcomes. Stick to your long-term investment plan. While recessions can be unsettling, it's essential to maintain a long-term investment perspective. History has shown that markets recover from downturns, and those who stay invested tend to reap the rewards over time. Avoid making impulsive decisions based on short-term market fluctuations. Focus on your financial goals and time horizon, and stay disciplined in your investment approach. The U.S. economy is facing significant challenges. GDP growth has slowed down, consumer spending is weakening, and the Federal Reserve's efforts to combat inflation have introduced new risks. These factors combined have increased the likelihood of a recession. While the job market remains relatively strong, there are signs of cooling, which could further exacerbate the economic situation. The economic outlook is uncertain. While it's impossible to predict the future with certainty, it's clear that the U.S. economy is navigating a complex and challenging landscape. It's essential to stay informed about economic developments and adjust your financial plans accordingly. Thanks for watching. If you found this video informative, please hit that like button and subscribe to our channel for more updates on the economy and financial news. Don't forget to share this video with your friends and family.